Well, many of you have already read the policy. Just a couple of points there. As far as the rates go, we didn't make any move. But I think what you should read in the policy is both our views on the evolution of inflation going forward, as well as focus on Part B, where there's a substantial number of actions that we have taken to facilitate growth and development of the financial sector. So with that as a preamble, I think we are happy to take questions.
Yes, Anil.
Good morning, Governor. Anirudh here from ET Now. So we all know that you don't like to be branded as an inflation warrior, but clearly going by the kind of guidance that you've given and the kind of risks that you've outlined on the 6% inflation target by January 2016, one does seem to get the impression that we might not see any kind of easing and possibly a cycle of rate hikes if you don't kind of reach that objective by then. So I just want to understand your views on that.
I don't think you should read that into the policy. What we have said is that we are currently positioned to reach the 6% by 2016 January, given where the rate is. Now, there are a number of disinflationary forces underway, which we've talked about. The low oil price is one of them. The fact that we have a relatively stable exchange rate is another. And the fact that wages, especially in rural areas, haven't grown as fast as in previous years is another positive factor for inflation. All these will combine to continue the disinflationary process we see reflected, for example, in core inflation. Headline, of course, has been buffeted a little bit by food inflation. There are uncertainties still, one of which is how food inflation will evolve over the course of next year, but there are also positives. And what we have to see is how this plays out. Now, I know there is some discrepancy between our modeling of inflation, which says that the expected level by 2016 is 7%. Of course, those are models, and the inflation stance or the policy stance is taken by all of us, putting our judgment also to work. And our judgment is that given all that we know about what is happening, we feel, and some of it is model plus some subjectivity, that we can still reach 6% by January 2016, given where we are. Now, of course, there are uncertainties, and therefore, given our model is saying is 7%, we are saying that the risks are still to the upside, though they've come down since the last policy meeting because the inflation readings have been better, the monsoon has been better, etc. What we end with the policy paragraph is that our actions will be based on a projection of inflation. We need to reach 6% by 2016. I think there's broad agreement that that is what we are trying to do. But it will be contingent on incoming data. So as of now, we are reasonably set. As of now, our expectation is we will reach that target. But of course, a lot can happen in the world. Oil prices which are low now can go up, or they can go even lower. Some people are projecting really low oil prices, others are projecting a reversion to where they were. Similarly, every other factor is subject to some uncertainty, so we have to see. The policy will be data contingent.
Subhashri?
At least in the policy and in the other documents, you've more mentioned about the cautiousness of not achieving the 6% target, the risks, upward risks to 6% target, and more than the downside and the achievability of 6%. What I understood from reading the policy is that it is more difficult to reach the 6% target than the 8% target, and therefore there could be a requirement of, if not rate cuts, if you have to continue to keep the rates on hold to achieve that, unless whatever risks you this thing matures. So I wanted to understand this part first, and secondly, what is your view about the real rate of real interest rates when it comes to as of now the current interest rate regime?
Okay. Number one, clearly there is a lot more confidence about reaching the 8% target than the 6% target. 6% target is a harder target, and it involves a 2% disinflation, at least as far as our projections go, from the beginning of next year to the end of next year. So that's a fair amount that needs to be done. I don't know what the evolution of policy rates will be. As I said, that will depend on data. Today, we think we are appropriately set, and that is why we reiterated, if you look at the words, we reiterated broadly the guidance that we gave in the August policy, but also emphasized that at least the data developments since August have been positive, that the monsoon has been better than expected, and of course oil prices have come down significantly since then. Also, I should mention that we continue being fixated about the value of the rupee against the dollar. But if you look at the value of the rupee against all other currencies, a 6-country basket or a 36-country basket, the rupee has actually been quite strong. So those are all factors that have played out in the inflationary process. And we have to wait and see how it develops. But I wouldn't read more than one should into the policy statement. We are a little better than we were in August, but we are still not, there are still risks in achieving the 6% target. We are more confident of achieving the 8% target.
Bijoy? The real rate?
What real rate is appropriate? I mean, you can't look at other countries and see what real rate is appropriate. I mean, clearly, what we would like to see is more households having confidence in fixed income securities in deposits and returning to financial savings. As you know, financial savings of households have dropped off considerably in the last few years. Some of that is because the tax benefits to financial savings have also come down in real terms, but some of it is also because the real interest rate has not been appropriate. Of course, in looking at the real interest rate, you have to balance the interests of savers as well as borrowers, and we'll have to find an appropriate mix. But that, again, is something that we will have to see as data evolves, and we will see credit growth, we will see deposit growth, we will see other sources of finance, how they grow, and may take a view.
Sorry, Vijay?
Governor Rajan, two questions. One is you've given a timeline finally for the HTM cuts.
Finally? I thought you used the word finally.
Finally, because earlier there was a timeline given that had to be reversed in the earlier tenure. So you'll have given a timeline for the HTM reversals. At the same time, you'll have allowed up to 7% of SLR to be factored in under LCR. Does this mean that SLR cuts, because effectively SLR becomes 15%? That means, have you achieved that 15% level that you're intending to achieve with for SLR? And will we then not see any SLR cuts?
I love September? The way you give me goals. I don't know where the intent to achieve. I mean, 15% is a number that's out there in the air. Look, the point is over time. Okay, first the rationale for the 5%. Our view is the banks are sitting on plenty of liquid securities. So to put them under more severe constraints through the LCR, when the objective of the LCR is met by their holding sufficient liquid securities, seemed a little bit of a travesty, a misinterpretation of the intent of the policy. And so our intent was to give them the flexibility to count some of that without actually selling those securities down. So SLR holdings achieve many purposes. One is liquidity. Of course, historically it's been a source of government finance. We have said that as the government's finances improve, we will steadily bring SLR down. Now, to what level? That depends. We'll have to take a view. I don't have a view in mind right now. But it will be a measured process. Right now, we want to deal with the problem of LCR, which is kicking in earlier than the evolution of SLR. So, given that, there is a special facility we will open. There will be some conditions on when it will open. We'll have to make sure that's consistent with Basel requirements. but that will give the banks flexibility to count some of those existing SLR holdings as part of their liquidity coverage, so they don't have to maintain additional liquidity. That's all. So this is flexibility for the banks. It doesn't say anything about the overall path of SLR and where that will be. The progress that you should expect is that over time, as government finances improve, SLR will be steadily cut to a level which is consistent with the liquidity needs and the prudential liquidity needs.
Okay. So just to an additional question, there have been some legal judgments against the willful defaulter stance that the RBI had, the earlier definition actually. Now you all have come up with a norm that indicates non-cooperative. Is this the way of actually ensuring that errant borrowers don't get away?
No, I mean they're tackling two different things. The willful defaulter is about somebody who has essentially done not used funds for the appropriate purposes. That's a crude way of saying it. I don't want to get into the legalese. The Honorable Court had some questions about whether all directors could be declared willful defaulters, and we've looked at that, and we are in the process of modifying the definition so that directors should be seen as culpable in the sense of actively participating or being grossly negligent in the willful default to be part of that willful defaulter list. So we are modifying that to deal with the concerns of the court, which obviously we have to respect. Going to non-cooperative defaulter, it's trying to tackle a different issue, which is there are some borrowers who basically resist repaying at every corner, holding up the process. And our sense is whatever their recourse to legal processes, which is allowable by the laws of the land, from a prudential perspective, they impose a cost to the system because banks cannot get their money using the existing laws such as SARFAESI. And therefore, in those situations where there is a deliberate attempt to delay and inhibit the process of recovery after due process has been followed, can we find a way of declaring these borrowers as non-cooperative? This is not a legal definition. It is a regulatory definition, which will mean that higher capital, higher provisioning will be required in further lending to these borrowers. So it's a purely regulatory structure, but which will increase the cost precisely because there are prudential risk.
Finally. Okay, Governor, I probably am repeating the question, but I wanted more color on this. You say that the future policy stance will be influenced by the Reserve Bank's projection of inflation relative to its medium-term objective. Your projection is 7% by the fourth quarter of 15-16, but your objective is 6%, and this will guide your policy stance. How should we understand that? Should we understand that you will have to therefore act more to get to 6%? Also, therefore, to repeat that question on real policy rates.
Let me answer this, then you go to the next question. As far as projection goes, you're taking the model projection. And what I was trying to say is model projection plus our subjective judgment as to forces the model is not capturing is our actual projection. And so our sense is that the projection, the mean, is around 6%. But the model is saying 7, so it does create a little bit of uncertainty as to whether we should put how much weight we should put on our subjective addition to the model. So our sense is the risks are to the upside, which we've said. Those risks which were to the upside also in the August projection have come down somewhat. But we're certainly in a situation where we're not saying the risks are to the downside, which we are saying for the short-term projection. So hopefully that clarifies that.
Not entirely.
Okay.
What I want to therefore know is that if the projection comes, as you say, along with the model, you add your subjective observations, and it indeed looks like the trajectory is towards your projected 7%. What will the stance
model
be?
projected 7%.
Yes,
Now you're getting
the model
specific.
projected 7%.
Yeah.
What will your stance be? Will it mean you will have to do more work?
Either way, I mean, I've said if the data come in and say that we're going to miss the 6%, we will have to tighten. If the data come in and say we will do better than the 6% or earlier than January, we will have room to be more accommodative. What I'm saying is we are currently appropriately positioned, but the data could come in either way.
Okay, I tried to tie in the real rate primarily because of that.
Next
Are we
question.
now appropriately positioned in terms of real interest rates, which is why you don't want to tinker with it? Therefore, if the projected rate of 7% happens, what would be the real interest rates that you will be comfortable with? If you wanted to come to 6, would it be a different real interest rate? If we have already arrived at 6, would it be a different real interest rate?
I'm not picking a real interest rate out of a hat. I want to see the evolution of credit, the evolution of activity, the evolution of deposits to determine where we feel comfortable. Remember, the real rate, as you well know, is composed of the nominal rate, policy rates which we set, plus whatever other credit spreads and inflation spreads that people and other spreads people put in, liquidity spreads and so on, minus inflation, right? And what is happening is inflation is coming down. So even without us changing the policy rate, to some extent the real rate has been widening over the last few months. From being strongly negative, it has become somewhat positive. We haven't seen a big response in financial savings thus far as a result of the rate becoming positive, partly perhaps because inflationary expectations have yet to adjust to the changes in inflation. Over time that will happen, so the expected real rate, which is the nominal rate minus the expectations of inflation, will then become positive. I think it's too early to say that the expected real rate is already positive right now. That will reflect in savings behavior. I don't know how fast that will move, etc. Also, we have to look at credit and the credit offtake, how that moves. So there are some uncertainties in this process, which is why I don't want to lock into a particular real rate. Then you have to tell me whether it's the real rate which is today or is the expected real rate, or there are lots of ambiguities there.
Is there normally in your mind an appropriate real interest rate for a country like ours?
No, I don't know what that is. I have to see how the various, aspects that we're worried about, investment, savings, credit, how all those move to get a sense of what I'm comfortable with. The world has changed a lot in the last few years, right? So a few months ago, they were saying that the appropriate real rate in the US was negative 6%, right? Now, given if the real rate in the US is negative 6%, or let's say even 0, what is the appropriate rate in India? I don't know. I need to see how all these variables move, and I think we'll be very pragmatic about it, and not locked into a view that the theoretical real rate is X. Usually people look at some factor of growth and so on to determine that. I think we'll be a little more pragmatic.
Let's go to the next question. Govardhan.
So you mentioned about the interest rates in the US outlook and how it's going. One aspect is that we have been talking about inflation in India, but there is a feeling that the rates in the West and the US is going to go up. How does that affect your stance, and what will be your stance on interest rates if the global interest rates go up? How would you respond?
I think that how the US interest rates, indeed other systemic central banks also, Euro may go the other way. So, there is not one single international rate, so to speak. But if you look at that composite, if that is likely to go up, in some ways that does constrain our elbow room to the extent that we are highly integrated with the global capital markets. And therefore that's a variable that we do need to keep in mind, but that would not inform fundamentally our interest rate policy, because that is geared towards the inflation objectives.
So this is Dinesh from First Post News website. Just want to know, how do you anticipate the additional risks on inflation because of this possible high prices on energy, in the energy fuel prices? The Supreme Court has cancelled the majority of the coal blocks which they have allotted. On the other hand, there is a revised gas pricing formula being worked out. So some expect, the fuel prices are headed upwards. So have you factored in, have you given a thought on this impact on overall inflation? That's the first question. Can I? One more. On one hand, you are fighting hard to contain the bad loan scenario in the banking system. You have a roadmap. On the other hand, two factors probably, which is new since your last policy. One, again, this coal block cancellation. So a chunk of loans have already gone into the development of coal blocks. That is one. And second is the Jan Dhan Yojana, this government's account opening program. About 1.5 trillion worth of loans are expected to be given through the overdraft facility, if I go by the reports. So, the government itself expect, bad loans coming out of this, because given the not so good KYC compliance in opening these accounts, there is no uniform documentation in opening these accounts. So, what could be the, does this give you additional concern, on the as you fight inflation? Thanks.
Let me take the first half of that long question, which is on energy prices. What we need to remember is that we are already importing a fair bit of coal from abroad for our power stations. I think the coal price, your question related to what would happen to electricity price. So there is already an imported element in it. Secondly, imported coal prices have also softened as part of the global commodity, compared to some time back. So while that could have some effect, it remains to be seen how much of the substitution will take place. And of course, the sector itself is dynamic. I mean, there is production increases by other coal companies where the allocations have been deemed legal. So it's not a static thing. Secondly, the electricity price is a regulated price. So that would depend on when these electricity price increases filter in through the system, and there may not be a one-for-one relationship at every point in time. So one is not terribly worried about this as impacting overall inflation, at least from my reading of it. But it remains to be seen as we go forward.
I guess the second question was
on the bad loan front.
Well, then there was a third question on Jan Dhan Yojana. On the bad loan front, let me just say that it is an issue we are following very closely. That while the size of the stressed assets in the system is large, I think if we take action to put the stressed assets back on track, that is the best way, the fastest way we can bring them down. And our entire pressure on the banks has been deal with the problem today. Don't postpone it to tomorrow, because tomorrow it's worse. The coal issue will have to be worked out. Let us see what the plans the government brings into play. Of course, a significant attempt to address the fundamental weaknesses in that sector and to get coal sort of flowing again, consistent with the high reserves that we have, could be the silver lining in this whole issue, that we deal with the problem once and for all with major reforms in the coal sector, which then make coal more available to the country for the growing needs. But we have to see how the legacy of the past is dealt with. I think the whatever solutions emerge will require, in a sense, compensation for some of the assets that are on the ground, and thereby some compensation to the banks who have lent against those assets. But let us see how it emerges. On Jan Dhan Yojana, our main we welcome the Jan Dhan Yojana. It's part of the RBI's plan to get universal access. There are many ways it can be done, and some of the new institutions which we've announced in this, that we're getting to closure on this policy, payment banks, small finance banks, will be vehicles towards that aim. What we've been saying again and again, I'm not as worried about the quality of the KYC. For small accounts, in fact, we have essentially allowed for KYC that can be upgraded over time. In fact, we've been quite liberal on KYC. What I'm more concerned about is that we actually achieve proper inclusion by bringing in households that were not reached in the past, and we bring them in along with things like unique ID and so on, so that the process of direct benefit transfer, which in a sense is the broader goal, can be achieved through these kinds of accounts. So let's keep the broader aim in mind and work towards achieving universal access, and we're working with the government to try and make this, this dream a possibility.
Thank you.
Okay. Anirudh.
Hi, Governor. Simran here from ET Now. I have a follow-up question. So bankers, we spoke to a couple of bankers after the coal verdict. So they have been saying they might approach the regulator for restructuring of some of the accounts that have been affected by the coal verdict, especially the small accounts. They're not really worried about the large ones. So will you allow some amount of flexibility or any kind of restructuring going forward to these companies which could get affected badly?
I think there is a fair amount of flexibility already built into our approach, and I think it would be premature to judge questions of flexibility. But I will reiterate, I mean, whenever we have issues of flexibility coming up, the real issue is putting the asset back on track, on recovering your loan, etc. It's not about postponing recognition of the problem. And let's keep that in mind, that ultimately these problems don't go away, they have to be recognized. Let's focus on that, the real issue is to put the real asset back on the ground, to make it income generating so that loans can be repaid.
We'll check if there are questions from outside Nimba.
Sure. Ladies and gentlemen, if you wish to ask a question, you may press star and 1 on your touchtone telephone. Participants in the audio bridge, if you wish to ask a question, you may press star and 1. We have a question from Manju of DNA. Please go ahead.
Good morning, Governor. I just wanted to ask you, how is the joint lending forum that banks have set up working out, and is it bringing down the pile of bad debts as banks are collectively dealing with the early warning signals?
Let me ask my Deputy Governor, Mr. Mundra, to speak about the Joint Lending Forum, and then Mr. Gandhi, if he has anything to add.
Yeah, Manju, from the introduction of the system, as you know, for the first 3 months it was more on a kind of pilot basis, and then it has progressed further. But in terms of the total number of accounts which are reported under the forum and the number which was there in January and amount, and when we compare with what is reported in recent months, there is a reduction in number as well as in amount.
Okay.
As well as in amount, and of course the reporting is only the initial part of it, then it has to be followed by the formation of JLF and the related action on that, and I think all the cases which are reported, those actions are being undertaken. So I think the system is settling down quite well. That is what the general impression we may get from it.
And one more question I had on the how much of bank finance is locked up in the companies or projects that project whose coal blocks were cancelled?
We have
We are yet to collect that information. That should be coming in the due time.
Sorry?
We are yet to collect that information. It will be coming because banks will be reporting once they recognize it as a SMA 1 or 2. It will be coming. So that time only we will be able to tell.
I have one last question. RBI holds about $73 billion of US Treasury bills. If in case the US interest rates were to move up, what would be the impact on the domestic liquidity, Governor?
I don't know if there's a direct impact on domestic liquidity. It just means that
Mark the market?
we'll have to mark to market, exactly. So, I mean, whether in recent weeks what has been happening is the dollar has been appreciating against other currencies. Therefore, when we look at our reserves in dollar terms, they've been coming down. Now, some newspapers make a lot of noise about it's coming down because we're selling dollars. I think the bulk of the action has been a revaluation of our foreign exchange reserves rather than any actions we're taking in the market. So similarly, if interest rates move up, we'll have to revalue our reserves based on what the mark-to-market value is. So we can't be preaching a different story to banks and then not mark-to-market our own assets. So we follow best practices there.
Thanks, Imba. We'll come back to this room. Two last questions. One, Amol.
Yeah, so thank you very much for allowing me to ask a question. Sir, I would like to draw your attention to real estate sector. Like food inflation you said, but I want to know whether inflation, real estate prices are a worry for you because banks are really directly associated with it. Demand and supply is a major indicator to the prices, and that drives the economy. But look at the real estate sector. If I'm, for example, observing it since last 5 years, the prices are still stagnant. I mean, they're just going up and there is no downwards. So how do you look at that sector specifically? Do you see any change there?
Well, depends on where and how much, but leave aside the Aurangzeb roads and the Malabar hills from the calculation, right? Generally, what you want to look at is whether real estate prices are increasing faster than inflation and at what rate. Now, in a growing economy, you might assume the value of land in real terms is also going to increase. The value of real estate will increase for that reason. But the question is at what rate? And my sense from looking at the housing data is that broadly, even when you say they aren't coming down, with 7-8% inflation, they're coming down in real terms. So they are becoming more affordable because wages are going up. At this point, as far as credit to the real estate, to buy real estate goes, I'm not overly worried because we do put a pretty hefty discount on the loan to value. The loan has to be for most houses at least at most 80% of value. Plus, and I'm not crowing about this, but I'm being realistic, there's often a cash component also in these purchases, which is pure equity that the buyer has in the house. So to that extent, there's a fair amount of cushion below the bank's loan, and so even though loan growth to the real estate sector has been quite strong, first it's still a relatively small portion of bank balance sheets, and second, there's a sufficient equity cushion as of now. Going forward, we'll have to see how the real estate prices evolve and at what point we start getting more concerned. But as of now, I'm not overly concerned, barring a few locations where it seems frothy.
So just last question on Jan Dhan Yojana, you clarified, but the point is earlier the banks were not, the KYC norms were not there. Now then the KYC norms came into the picture. Now you're saying that you're giving some relaxation to the KYC norms. For Jan Dhan Yojana, you don't need any KYC. How actually you're dealing with KYC norms? Because I mean, looking at the growth of, looking at the population of the country, 50% people still don't have enough documents and they don't still understand the financial language.
No, look, there are a variety of relaxation that were already in place beforehand, right? One was, for example, that you did not have to, and correct me if I'm wrong, would you like to explain the KYC? Yeah.
Recently, we have clarified that only one document is needed out of the total documents which are listed. All these things are as per the PMLA rules. So the relaxation now which has come for Jan Dhan Yojana related to starting the account process. That is a simple declaration with the 2 photos also. One can start a small savings bank account. That's the one they will be able to start. But to graduate into a normal account, then regular KYC procedure will be kicking.
I'll just add to what you are mentioning. One thing is there is a timeline. By then, documentation has to be completed. Till such time, there are restricted transactions. Second part of your question that people are not aware, you understand the entire financial inclusion program also includes the financial literacy, and that is going on side by side. So as the people are educated in that, they are expected within timeline there would be a compliance.
One last question from Gabriel.
Hello, Gabriel Perosini from the Wall Street Journal. Good morning, Governor. We have interviewed, like other colleagues from the press here, economists ahead of this policy meeting, and the response that we got were unanimous on predicting your move today, or your absence of thereof. On the other hand, going forward, the consensus is a bit less unanimous, if I may say. So your next move is forecast to happen between the first quarter of next year and the second half of 2016. And also, there's no agreement about the direction, because some economists forecast a cut and some economists forecast a hike. Now, my question is, are you satisfied with the kind of guidance that you're giving to the market? And also, I have another small question. India, as you pointed out earlier, has been on a category of its own. The rupee has been pretty strong compared to other emerging market peers. Do you think that's part of a new scenario that is gonna be the case going forward? That India is just gonna be one market on its own and is not going to be associated to other peers, as it was the case with the BRIC or the Fragile Five? Thank you.
First question, I think that's appropriate given how much we know. We are staying away from predicting what the policy, how the policy will evolve going forward, because it's going to be data contingent. And as the incoming data, we see the incoming data, our projections will change, both our objective model-based projections and our subjective projections, and we will adapt policy accordingly. There will be no change in the goal, which is to reach that 6 by January of 2016. So I'm not uncomfortable with people on both sides of the spectrum. That does suggest that the uncertainty about the data is on both sides. Some people are fairly confident the disinflationary process is well underway and we will see substantial disinflation, and others are more skeptical and worry about some additional risks. In recent weeks, the skeptics have been coming down a little bit, but I think they still are there. So that's why you see a variation. On the second question, I mean, you see, one of the dangers in I think economic reporting is we continuously obsess about the rupee-dollar exchange rate. And if you look at the rupee-dollar exchange rate, yesterday in the news was the rupee has hit a new 7-month low. But if you look at any reasonable measure of the rupee against multiple currencies, which is what we should, given we are looking at a trade-weighted basket, in terms of the question that you asked about the rupee strengthening, the rupee has strengthened. Precisely because the dollar has strengthened against everybody else. The dollar index is about 6 or 6.5% stronger than it was at the beginning of the year. And we've broadly held parity with respect to the dollar where we were in the beginning of the year. So we've strengthened along with the dollar. Now, is that something that is that something that we're aiming for or anything of that sort? We've said repeatedly we're not focused on the level for the exchange rate. What we want to do is reduce undue volatility. And that typically means intervention on both sides. Though, of course, in recent months, with the strengthening of the views on India, especially after the stable government, there's been a lot of money pouring in, and many of the views have been one-sided about India. Now, we've taken that opportunity to build some reserves. But going forward, again, we're not, there's no level that we have in mind. Our main objective is to limit volatility when we think it is undue.
Thank you very much. Thank you, Inba. We can close the conference.
Thank you. Ladies and gentlemen, on behalf of Reserve Bank of India, that concludes this conference. Thank you for joining us, and you may now
Please take
disconnect.
to the executive, please.